Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for Nasdaq ETF's Cabana Week is Scott Kefer, senior portfolio manager at VictoryShares and Solutions, to discuss evaluating the 40 in a 60-40 portfolio. Scott, it's great to see you. Welcome back to Trade Talks.
Thank you, Jill. It's great to be back.
Given the current low rate environment, many investors are reevaluating their income strategies. What are some solutions your team is advocating?
Yeah, Jill, this has become probably one of the most talked about topics as I meet with advisors and our clients. You know, for the last almost 40 years now, the 60-40 portfolio of stocks and bonds has really served investors incredibly well. But when you think about the two primary roles of fixed income in a client's portfolio, it's really the income generation and the diversification, or the lower correlation it can bring to, namely, offset your equity allocation. And right now, both of these objectives are potentially challenged. We have historically low rates, which are clearly pressuring the income generation side. And when you consider this unprecedented amount of fiscal and monetary stimulus that we pumped into the economy, the potential of the reflationary effect that could occur as the economy begins to eventually reopen, there's a potential risk for some level of inflation creeping in, impacting rates and therefore bonds. And we're already seeing this. 6 months ago, the 10-year had a 60 basis point yield, and now we're over 110. So as you said, this is leading many investors to reevaluate their fixed income strategies and to reevaluate that, pillar of the 60-40 portfolio. So what are they looking for? Well, in particular, the people we speak to, they're looking for strategies that can provide an alternative form of income, but also offer a low correlation of stocks and bonds. And given the backdrop, we've seen a tremendous amount of interest in our Victory Market Neutral Income Fund. The ticker for that is CBHIX. And the strategy offers an attractive level of income. It has a volatility profile very similar to what you'd find in the Bloomberg Barclays Ag Index, so behaves like a traditional bond strategy. And it has a low correlation of stocks and bonds, even slightly negative to bonds over a 3 and 5 year period. So historically, it's done a great job delivering on those two objectives. Fixed income has provided that I outlined earlier, the income and the diversification.
And Scott, for investors that are currently looking to incorporate fixed income into their allocations, what advice would you give them? In other words, how do they allocate to alternative income strategies in their portfolios?
Sure. So I can tell you that in my own team's asset allocation work, where we manage things like target date funds and target risk portfolios and multi-asset solutions generally, we're using the Market Neutral Income Fund to help lower duration by funding its allocation from areas like longer dated treasuries and intermediate core or core plus solutions. And we're seeing many clients really make very similar decisions. So, we've seen some clients actually completely rethink their asset allocation models, where instead of a 60-40 of stocks and bonds, they're creating 60-20-20, where the extra 20% is going into liquid alternative solutions that include strategies like our Market Neutral Income Fund. Again, trying to play that role and the goal of providing income, bond-like levels of volatility and risk characteristics, and that low correlation to stocks and bonds.
All right, Scott, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.